for digital assets, I focus on Bitcoin because I'm so concerned about the fiat system. So having spent my life in fiat, I want insurance against the Fiat Ponzi. And Bitcoin, with its fixed supply and largest market cap in the digital asset ecosystem, I feel that Bitcoin is the best digital asset. But I don't ever advocate anyone to go 100% into Bitcoin. That would be irresponsible risk management. I don't tell other people not to do that if they have the conviction. But the beautiful thing about Bitcoin and its asymmetry to the upside is you only need to hold between 5 and 10% of your entire portfolio in Bitcoin to participate in the incredible asymmetric upside. And that's the way you manage risk, as far as my career has taught me.
Inflation is a buzzword that permeates both traditional and decentralized banking. International leaders are still debating whether the current situation qualifies as a recession, while banking industry specialists are considering possible solutions. There are concerns about whether virtual currencies like Bitcoin are the solution, as they are increasingly regulated, adopted, and thrust into the mainstream. Despite the present market environment raising questions about Bitcoin's ability to serve as an inflation hedge, Foss thinks it is one of the most significant technological and financial solutions to our looming debt dilemma. Foss, as an experienced investor with years of financial industry experience and a comprehensive understanding of the financial system, he is worried about the fiat system and the possibility of its collapse, which is why he has opted to concentrate on Bitcoin as a digital asset. As a Bitcoin maxi, Greg thinks that Bitcoin, with its limited supply and top market cap in the ecosystem of digital assets, is the best defense against the fiat Ponzi. He promotes prudent risk management and contends that owning 5 to 10% of one's portfolio in Bitcoin is an effective method to share in the cryptocurrency's potential gains while simultaneously minimizing potential losses. The Bitcoin price has recently been trending upward, reaching a high of $19,000, the first time in a few months that it has reached that level. Greg explores the various causes of this movement since he considers it to be intriguing. He draws attention to the fact that the Consumer Price Index, CPI, came in on target, which may mean that we are on track to achieving price stability, the Federal Reserve's desired outcome. Inflation and the Fed's monetary policies, however, are two other issues that Greg raises. He notes that while inflation grows over time and is built on a base of 6.5%, reaching a 6.5 inflation rate after 8 readings is not a significant achievement. The Fed's rate rises over the past 12 months have been the fastest in the previous 40 years, highlighting the fact that monetary policy often lags economic policy by at least 12 months. In addition, Greg brings up Jamie Dimon, CEO of the biggest bank in America, who thinks the Fed may be overreacting and that a pause may be necessary. We'll now watch the video to hear Greg Foss' thoughts on the Fed rate hikes, Bitcoin, and everything else going on in the cryptocurrency and financial sectors.
The reason I have some concerns, well, twofold. Firstly, people need to understand that inflation actually compounds, right, Paul? So achieving a 6.5% inflation rate after 8% readings in the past, that's not that substantial, given that you're building on 6.5% on a base of 8% to begin with. So, we could go 8%, 6.5%, 4%, 2%, -4%, -6%, and you'd still have a positive inflation rate over the last 5 years. And this is not good. So we need to understand the mathematics first. And then second, and most importantly, monetary policy tends to lag by a period of at least 12 months. And the rate increases invoked by the Fed over the last 12 months have been the fastest in the past 4 decades. So we've raised rates at a second derivative, or the rate of acceleration of the rate increases has been second to none over the past 4 decades since the Volcker area. And I think there's a lot of uncertainty as to how that will actually play out. I'm not the only one, and most people shouldn't really care what I say, but I think Jamie Dimon is saying the same thing. CEO of the largest bank in America, he has data that he's privy to data that no one else is, and he believes the Fed might be getting a little ahead of themselves and perhaps a pause is warranted. But I'll just, paraphrasing Jamie Dimon, we're by no means out of the jungle or out of the woods yet, in my opinion. I anticipate a 25 basis point move or a pause. So I don't think 50 basis points is on the table. But that being said, now listen, who is Greg Foss? I am not an interest rate procrastinator. What I like to look at are things that you just mentioned, things like credit spreads, where I've spent my entire career as a distressed debt trader and a junk bond trader. Those are far more telling than a 25 basis point increase on top of, and this is key, on top of a 4 3/8 increase so far. So, it's again the magnitude of the increase, the acceleration of, 475 basis point increases in a row. It really doesn't matter, in my opinion, whether we go 25 basis points or 0 basis points. It's what we've done in the past and waiting for that to trickle through to the economy in real time, which will be reflected in credit spreads and volatility and other risk measures in the markets. Look at the difference between things like Capital One Financial. Yes. So that's lower, that's the lower quality credit cards versus something like American Express or whatever. Just look at the stock price performance of them, and you'll get an idea that the concerns in the market for the difference between credit to the more privileged, we'll call it, or the more affluent versus credit to the less privileged or working class. And I'm not trying to parse the population, but that's the reality, is how the credit cards are distributed. So be very careful about drawing a blanket sort of conclusion. They might be going out giving credit cards to their primary clients who can still afford credit cards, but there's a lot of clients that are absolutely maxed out anyway. So I would not be out there as Capital One Financial being excited about giving new credit to my clients who are already way underwater. It's exactly just a recipe for disaster.
In conclusion, Foss is particularly concerned about the status of the fiat system and the possibility of its collapse due to his breadth of knowledge in the banking business and keen eye for current market trends. He thinks that looking at indicators other than interest rates, such credit spreads and risk metrics, can provide greater market knowledge. Additionally, he draws attention to a worrying trend in which banks are actively seeking out new clients, which may be a sign that many people have already reached their credit limit. Additionally, he draws attention to the disparity in loan availability between wealthy and less privileged groups in society and urges prudence when choosing investments. In general, Greg highlights the significance of maintaining knowledge and being aware of the state of the market in order to make wise financial decisions. This video has come to a conclusion, and we'd want to hear your thoughts in the comments section. Additionally, click the like button, subscribe, and enable notifications whenever possible.